Most SIP investors, even experts these days, believe that if they invest in a disciplined manner in Indian equity markets through the SIP route for a period of, let's say, 4 to 5 years, then they will almost certainly end up with at least a low double-digit return, 11 to 12% per annum. But what if I told you, even after investing through the SIP route in the Nifty, not for 1 year, not for 2 years, not for 3 years, but for 7 long years, the probability of ending up with even low double-digit returns, 11 to 12% per annum, has historically been only 50%. That's the same as the probability of getting a flip of a coin, right? My dear friends, if you are one of those who believes that just by investing in a disciplined manner through the SIP route for a very long period of time is going to automatically ensure very good inflation beating returns, then I'm sorry, I have bad news for you. But the good news is that by making few small tweaks and introducing an element of timing in your SIPs, you can take the probability of low double-digit returns from a 5-year SIP in the Nifty to upwards of 95%. My dear friends, over the last 3 to 4 months, I have been relentlessly talking about a bunch of global macro parameters, stuff like the yield curve, the reverse repo facility, the Fed funds rate, the amount of money that the Federal Reserve has printed in the US over the last many years, and how these global macro parameters have historically been very useful in identifying periods that have eventually turned out to be very conducive for equities as an asset class, and also in identifying periods that have turned out not to be conducive for equities as an asset class. But let's face it, my dear friends, that most of these parameters that I have talked about are related to the US markets and the US economy. Can these parameters and the signals emanating from these parameters really be relevant for us here in India? Can the signals emanating from these parameters really be applied to our day-to-day investments, day-to-day SIP investments and lump sum investments here in India, such that it can produce a tangible improvement in the final outcome of SIP and lump sum investments here in India? Because if that's not the case, then everything that we have discussed over the last 3 to 4 months is probably just theoretical bookish knowledge, which has very little real world application. And in that case, we should simply defer to conventional wisdom stuff such as time in the market is more important than timing the market and stuff like that, So my dear friends, this is really the moment when the rubber meets the road. This is really the moment when we get to test whether everything that we have discussed over the last 3 to 4 months can really be applied to introduce an element of timing to our day-to-day SIP investments here in India, such that we can bring about a tangible improvement in the outcome of these investments. But before I discuss how these global macro parameters can be used to introduce an element of timing in our investments here in India, I want to discuss what I see as 2 fatal flaws of a conventional SIP-based investment approach. Now, for those of you who are new to the world of personal finance and are probably not very familiar with the concept of a SIP, well, a SIP stands for Systematic Investment Plan. So what exactly is an SIP? A SIP is an investment approach wherein the investor invests a fixed amount every single month for a very long period of time. The investment amount doesn't matter. You could be investing 1,000 rupees every month or 10,000 rupees every month or 50,000 rupees every month. The amount itself doesn't matter. The amount is a function of whatever is your monthly investable surplus. But whatever is your monthly investable surplus, you invest that amount every single month for a very long period of time. So let's say if you're doing a 5-year SIP, in 5 years you have 60 months. If you're doing a 5-year SIP, then you invest a fixed amount every single month for 60 months. What is the logic behind doing that? Well, the logic behind investing a fixed amount for a very long period of time at monthly intervals is that when you do that, some of those monthly investments would happen during times when the markets are going through a very high valuation, such as right now. And some of those investments would hopefully also happen during times when the markets are going through a correction. And in the process, your investments would be able to capture a good average buying price. And then at the end of 4 to 5 years, if you need to redeem these investments to meet any financial goal, hopefully you will be able to sell your investments at a significant profit. So that's the logic behind a SIP. Now, this in itself is a very powerful logic. And I'm not here to dismiss the merits of a SIP based investing approach. This logic, in fact, is so powerful and so convincing that most retail investors here in India, even experts, have now come to believe that when you invest in a bank fixed deposit, you will end up with returns of the order of 7 to 8% per annum. But when you invest in equity markets through a SIP based investment approach, for a period of, let's say, 4 to 5 years, you're almost certainly going to end up with at least a low double-digit return of 11 to 12% per annum. And because of these kind of assumptions, SIP has become one of the most popular ways for retail investors to invest in equity markets here in India. So much so that the amount of inflows coming into the mutual fund industry from SIP investors has now crossed a staggering level of more than 21,000 crores per month as of June of 2024. That's more than $2.5 billion worth of monthly inflows coming into the mutual fund industry from small retail investors of India every single month. But how sound are these assumptions which are driving the growing popularity of SIPs here in India? Can SIPs really be considered to be a reliable way of generating at least a low double-digit return, 11 to 12% per annum, if one sticks to a SIP journey in a disciplined manner for a period of, let's say, 4 to 5 years? Let's examine. Now, nobody can predict what's the kind of returns SIP investors would be able to generate over the next 4 to 5 years. But what we can find out is go back in history and check what's the kind of returns investors would have been able to generate historically had they invested in India's primary stock market index, the Nifty 50 index, based on a SIP-based investment approach spanning 5 years. What you see on your screen right now is a chart that depicts the historical performance of a 5-year SIP in the Nifty. In technical language, this is also called the rolling return of a 5-year SIP in the Nifty. If that sounds like a lot of jargon, don't worry, I'm going to break it up for you in very, very simple language. What I've tried to do in this chart is to go all the way back to the turn of the century, all the way back to January 2001. And then what I've tried to find out is, had you started a 5-year SIP in the Nifty in any month since January 2001, then what is the kind of return that you would have got from that SIP? So for example, had you started a 5-year SIP in the Nifty in January 2001, then that 5-year SIP would have gone on till January 2006. And at the end of January 2006, the return that you would have got from your 5-year SIP in the Nifty would have been 30.44% per annum. Instead of January 2001, had you started your 5-year SIP in the Nifty in February 2001, then that 5-year SIP would have gone on till February 2006. And the return that you would have got from this 5-year SIP would have been 32.01% per annum. Between March 2001 and March 2006, 33.83% per annum. So like this, if you keep moving 1 month at a time, and for each of these months, if you keep finding out what is the return that you would have got from a SIP in the Nifty over the next 5 years, then you would get to the most recent 5-year period for which data is available. Now I'm recording this video in July of 2024, and the most recent 5-year period for which data is available is July 2019 to July 2024. And had you done a SIP in the Nifty during this 5-year period, as you can see on your screen right now, the return that you would have got from that 5-year SIP would have been 19.18% per annum. Now, another important data point coming out from this chart is that we have had 223 months that have passed by since January 2001. And had you started a 5-year SIP in the Nifty in any of these 223 months, then the return that you would have got from each of these SIPs can be found in this chart. And if you want to find out what has been the historical probability of getting a return of 12% per annum or more at the end of a 5-year SIP in the Nifty, then what you have to find out is, out of these 223 months, in case of how many months SIP in the Nifty over the next 5 years would have produced a return of 12% per annum or more. And when you do that exercise, you will find out that only in case of 119 months out of 223 months, a SIP in the Nifty over the next 5 years produced a return of 12% per annum or more. 119 out of 223 effectively translates to a probability of only 53%. So what that effectively means is that the historical probability of getting a return of 12% per annum or more at the end of a 5-year SIP in the Nifty has been only 53%. Why do I say only 53%? That's because when you flip a coin and you try to guess whether you're going to get heads or tail, the probability that your guess is going to be right is 50% only. So effectively, the historical probability of getting a return of 12% per annum or more at the end of a 5-year SIP in the Nifty has historically been almost the same as getting a flip of a coin right. Just imagine a low double-digit return of 12% per annum or more, something that most SIP investors in India have come to believe is a given when you invest in a disciplined manner through a SIP for a period of 4 to 5 years. In reality, the historical probability of getting that low double-digit return of 12% per annum or more at the end of a 5-year SIP in the Nifty has been just about the same as getting a flip of a coin right. Try to understand the implications of that, especially if you have a financial goal that is due in next 5 years. Let's say if you have a child in your family who is in class 7 right now. This child is going to finish schooling, is going to finish class 12 in next 5 years and will go to college in 5 years' time. Let's say if you have a financial goal to build a corpus to pay for your child's college admission fees, and you want to build this corpus by investing in the Nifty through a SIP over the next 5 years, then what is most likely going to happen is that your financial advisor is going to calculate for you what is the SIP amount that you need to invest over the next 5 years in order to get to your target corpus to pay for your child's college admission fees. And while doing this calculation, your financial advisor will very likely assume a return of at least 12% per annum or more from this 5-year SIP over the next 5 years. But the historical probability that this assumption has been right has been only 53%, which basically means that the chances of a 5-year SIP in the Nifty being able to get you to your target corpus at the end of 5 years, at least going by historical precedence, is just about 50-50. My dear friends, just think about it. Given these numbers, can you really depend on a SIP in the Nifty for a period of 4 to 5 years to reliably get you to your financial goals? So that's the first major flaw of a SIP. The chances of even a moderate return of 12% per annum is very, very low. I'm not talking about 15%, 20% per annum. I'm talking about a low double-digit return of 12% per annum. That's the very least that you need if you have to beat inflation comfortably by 3 to 4 percentage points after factoring in taxation. The chances of ending up with even that low double-digit return of 12% per annum or more is just about the same as getting a flip of a coin right. Now let's move to the next flaw of a SIP, and for that we need to understand what has been the historical range of returns that has been produced by a 5-year SIP in the Nifty. So basically we need to understand what has historically been the best case return of a 5-year SIP in the Nifty and what has historically been the worst case return of a 5-year SIP in the Nifty. So let's look at what those numbers have been. As you can see on your screen right now, historically, the best case return of a 5-year SIP in the Nifty has so far been 45.43% per annum. You would have got this spectacular return had you done a SIP in the Nifty between November 2002 and November 2007. And historically, the worst case return of a 5-year SIP in the Nifty so far has been negative 5.82% per annum. You would have got this terrible return had you done a SIP in the Nifty between April 2015 and April 2020. But why was the return of a 5-year SIP in the Nifty between April 2015 and April 2020 so terrible? It was so terrible because this 5-year SIP ended in the middle of a 40% crash in the Nifty that was witnessed during the onset of the COVID pandemic. And why was the return of the SIP between November 2002 and November 2007 so spectacular? It was so spectacular because this 5-year SIP ended in the middle of a market peak. Now, those of you who are familiar with the history of the Nifty would know that the Nifty experienced its worst crash in the year 2008. That year, between January and October, the Nifty corrected by a whopping 60%. But if your 5-year SIP in the Nifty ended at the market peak that was formed before the start of this crash, and that market peak was formed around November 2007, then you would have ended up with returns as spectacular as 45.43% per annum. What does this tell us about the final outcome produced by a 5-year SIP in the Nifty? This tells us that the final outcome produced by a 5-year SIP in the Nifty depends on only one factor, and that is market conditions in the terminal year of your SIP. If your SIP ends up at a time when the market is going through a huge rally, then you can potentially end up with spectacular returns of 40% per annum or even more than that. But if you are unlucky and your SIP is ending at a time when the market is going through a severe downturn, going through a severe crash, then you can potentially end up with even negative returns. My dear friends, once again, try to understand the implications of this if you are trying to depend on a 5-year SIP in the Nifty to achieve a financial goal. We are right now in July of 2024. Let's say if you have a financial goal that is due in next 5 years, that is by July of 2029, and if you are depending on a 5-year SIP in the Nifty between now and July of 2029 to achieve that financial goal, then you are taking a very grave risk. And that is because, as we just saw, the outcome of a 5-year SIP between now and July of 2029 is likely to depend on only one factor, which is market conditions around the time the SIP is coming to an end in July of 2029. If July of 2029 happens to be a time when equity markets are going through a huge rally, then you're likely to end up with very good returns on your 5-year SIP between now and July of 2029, maybe 40% per annum or even more than that. And the implication of that will be that you will be able to very easily achieve the financial goal for which you are trying to save up between now and July of 2029. But if God forbid July of 2029 happens to be a time when the world is going through warlike conditions, or if the world is going through another pandemic, and as a result of that, equity markets are going through a huge downturn, then you could also end up with negative returns. And the implications of that would be that you would fail to achieve the financial goal for which you are trying to save up between now and July of 2029. And guess what? We are right now in July of 2024. And there's no way to predict what kind of market conditions are we likely to see 5 years down the line in July of 2029. And that's why it becomes so risky if you are trying to depend on a SIP in the Nifty between now and July of 2029 to achieve a financial goal. And this risk, as I just explained, is because of the second major flaw of a SIP, which is that despite all the averaging that you try to do by investing through a SIP over many years, the final outcome of the SIP boils down to just one factor, which is market conditions in the terminal year of your SIP. Now, many of you might argue that so what if the markets crash in the fifth year of your SIP and your returns turn negative? You don't necessarily have to liquidate all your holdings in the middle of a market crash. You can always wait for a couple of years for the markets to recover, right? That's a valid point, because after every major market crash, markets eventually do recover. But my dear friends, what you also have to realize is that the nature of your financial goal may be such that you may not necessarily have the luxury to wait for a couple of years for the markets to recover. So for example, if you go back to the financial goal that we discussed in this very video a little while back, which is that let's say you have a child in your family who is likely to finish schooling and go to college in 5 years from now, and you have a financial goal to save up for the child's college admission fees by investing in a SIP over the next 5 years, then in the case of this particular financial goal, the amount required for college admission is due on a fixed date, which is 5 years from now. Even if the markets crash in the 5th year of your SIP and your returns turn negative, you can't possibly go back to the college and ask for more time for the markets to recover so that you can pay the college admission fees later on. That particular fees is due on a very specific date, and that date is 5 years from now. What's the solution? One possible solution could be that you could start planning for your financial goal a little earlier. Instead of trying to achieve your financial goal through a 5-year SIP, you could try and do that through a 7-year SIP. But can a 7-year SIP in the Nifty solve the problems that we saw in case of a 5-year SIP? Let's check that out. What you see on your screen right now is the historical performance of a 7-year SIP in the Nifty. And as you can see, the best case performance of a 7-year SIP in the Nifty has so far been 37.25% per annum. This return you would have achieved had you done a SIP in the Nifty between January 2001 and January 2008. But the worst case return of a 7-year SIP in the Nifty so far has been negative 1.04% per annum. You would have got this return had you done a 7-year SIP in the Nifty between April 2013 and April 2020. And to that extent, many of the problems that we saw in case of a 5-year SIP continues to persist even in case of a 7-year SIP. So for example, even in case of a 7-year SIP, if the final terminal year of the 7-year SIP coincides with a large market crash, then the return of that 7-year SIP can turn negative. And that's the reason why the return of a 7-year SIP in the Nifty between April 2013 and April 2020 ended up being negative 1.04% per annum. Not just that, the historical probability of ending up with a modest return of 12% per annum or more at the end of a 7-year SIP has been just 50%, which is just about the same as what we saw in case of a 5-year SIP. And this, my dear friends, in my view, constitutes the biggest curse of a SIP-based investment approach. Because after investing not for 1 year, 2 years, 3 years, but for 7 long years, and that too through a SIP, you can still end up with negative returns. Not just that, the historical probability of ending up with even modest low double-digit returns, 12% per annum or more, continues to be abysmally low. Just 50%. That's the same as the probability of getting a flip of a coin right. And that's why, my dear friends, many retail investors end up giving up on their SIP journeys. Even if the nature of the goal for which they are trying to save up for is of a very long-term nature, even if they're, let's say, trying to save up for their retirement, which is due in, let's say, 20 years or 30 years, humanly, it becomes very difficult to continue with your investment journey if at the end of 7 long years of investing, you still face the prospects of ending up with negative returns. In fact, forget about negative returns, which to be honest happens only in extreme conditions. Humanly, it becomes very difficult to continue with your investment journey even if you fail to see at least low double-digit returns with a reasonably high probability after 7 years of investing, isn't it? Just imagine, even after investing for 7 long years, if you're still languishing with, let's say, 5%, 6% or 7% returns, what is the likelihood that you will be able to get the conviction to continue with your SIP investments for another 5 years, 10 years or 15 years? It's going to be very, very unlikely, right? And this is the problem, my dear friends, that we are trying to solve for our clients. Is there a way to invest in Indian equity markets in such a way such that if an investor invests through the SIP route for a period of 4 to 5 years, he can end up with at least low double-digit returns, 11 to 12% per annum returns, even if the terminal year of his SIP, the last year of his SIP, coincides with a large market correction? Well, what do I mean by that? We saw a little while back, while studying the historical performance of a 5-year SIP in the Nifty, the worst case return of a 5-year SIP in the Nifty has so far been negative 5.82% per annum. And this happened when the 5-year SIP in the Nifty ended at a time when the Nifty was going through a painful 40% correction that was witnessed during the onset of the COVID pandemic. As opposed to this, I am talking of an investment strategy through which investors can potentially end up with not just positive returns, but with positive 11 to 12% per annum returns, even if their 5-year SIP ends up at a time when the Nifty is going through a very large correction. In other words, what we are trying to do is, instead of trying to chase very high returns all the time, we want to chase reasonable returns, 12% per annum or more, but with a very high probability of 95% plus. And we want to do that because in our view, that's the only way to ensure retail investors can stay committed to their SIP journeys for the long term and do not lose conviction midway through their SIP journeys. But my dear friends, this is a really big challenge. We have set up for ourselves a target which is really steep. Is it even mathematically possible to ensure that we end up with not just positive returns, but with positive 11 to 12% per annum returns at a time when the markets are going through a 40-50% correction? Well, that's exactly what we are going to explore in the part 2 of this series. So please stay tuned. This brings me to the end of this video. I really hope that you liked the insights that I shared during the course of this video. If you did, then please do like and share this video. And one last humble request, please do consider subscribing to my channel. This is one thing that will not cost you anything, but would be immensely helpful in increasing the reach of my channel and my videos. Thank you very much.